You're getting two on the same day, direct listings. How confident are you that this is going to go off without a hitch?
Yeah, we really excel in complex transactions, so we're excited about the day today. Not only do we have two direct listings, we have two IPOs and two SPACs. So we're ready, we're locked and loaded, and it's going to be a great day.
So for Palantir specifically, though, it's gotten all the buzz, all the excitement, but there's also been a lot of criticism as to the governance of it and how much Peter Thiel, for example, is going to control of the stock and voting rights. How do you see that debate playing out as more companies may opt for direct listings and try and keep more control?
I think what you're going to see across the choices of paths to public now, and that's really what this is. This isn't replacing an IPO, but companies are going to be able to choose. Do they want to go public via traditional IPO where they have the infrastructure in place that goes along with that and some control over their initial shareholders, or a direct listing which reduces their cost of capital, or a SPAC which gives them more control around the negotiated price? Where I think the next evolution you're going to continue to see is what elements of each of these paths to public do others start to adopt. So Palantir is introducing lockups and dual class structures. We've seen IPOs already start to refine some of the lockup mechanisms that were traditionally there. We've seen SPACs start to evolve their sponsorship models. And so we're going to continue to see change and evolution in each one of these paths. The important point is it's not one size fits all. Not all companies are created equal. We're going to support them at the New York Stock Exchange on whichever path makes most sense for them and their investors.
Okay, Stacey, let's just talk about that. Are we starting to reach, though, the limits of what is acceptable governance? The three founders of Palantir basically are going to be able to retain control of this business almost regardless of how much they own of it. They're going to have to own some of it, but nevertheless, until they die. And I'm wondering whether public markets are going to be undermined if we see a continuation of this trend in governance.
It's really important for investors to choose and reward what they want to see by putting their dollars in the companies that they support. If companies choose to stay private because they feel forced to give up control when they go public, investors lose access, and the everyday investor, importantly, loses access to those companies in the private markets. We believe strongly in the fact that this nation has been built on the fact that it's a story of shared success as companies grow. And if we don't allow the everyday investor to share in that success by having access to those investment opportunities, I worry that we're going to really redefine the fabric of this nation. So it's important that they are public companies so people do get to share in that success. But investors should reward the behavior that they want to see, and they can do that by investing in governance structures they believe in.
Do you really feel, though, that everyday investors are going to understand the distinction of all of that and know that they don't really have control in these companies?
They don't even have the option to invest in them as private companies. And that's a really significant difference, right? You think about a company like Salesforce, who went public in 2014 and has returned 5,600% as they grew in the public market since then. Those companies are staying private much, much longer. And in many times because they're concerned about the undue pressure as a public company on short-term thinking around quarterly earnings. Some of them are adopting governance structures that allow them to maintain control as a public company, at least in the early years. And if we don't support that mechanism, my concern is the pendulum will stay where it was in the private markets. 2020 really showed how the strength of the capital markets and the fact that companies under pressure because of the pandemic could easily raise money. And we've raised over $130 billion via companies on the NYSE, both through IPOs and follow-on offerings. So the public markets have real value. We want to see that swing back.
Absolutely. But there needs to be checks and balances, Stacey. The individual investor is less sophisticated in public markets generally than they are in private markets. They don't have the capacity to have the analysis that exists in private markets. There need to be checks and balances. If I'm investing in a company where I don't have control and the founders keep control, they are not taking the economic risk in the way that they once were. How is that correct? Why shouldn't there be greater checks and balances in the public markets than there are in private markets?
Balance is such an important word, and we balance investor protections and investor access. Transparency and disclosures around the structures that exist is how we give investors the tools they need and the information they need to make informed decisions. But they need access to those opportunities. Denying them access is not the right answer. We want to empower them with information so they can choose what's right for them, and investors should vote with their money.
And one more question on this particular point. Do you feel like there are a lot of companies in the pipeline like a Palantir that have stayed private a lot longer and are going to move onto the public market at maybe a lower valuation and bring up this conversation? Like, what's in the pipeline?
We've seen September has been the busiest month at the New York Stock Exchange for IPOs in our history. And October is on track to look exactly the same. So it's been very, very busy. And I think that's reflective of the fact that companies have been private for a really long time and took for granted that they would always be able to raise capital in the private markets. And this year has been challenging. It changed the dynamics around the cost of capital in the private markets versus the public markets. So we're seeing a lot of companies looking to tap into the public markets as they're uncertain about what the future might bring based on the pandemic, based on economic conditions. And so we are seeing more companies come to public, and that's not a trend we see slowing down.
Stacey, let's switch subjects. Are you 100% confident that you can justify the fees that you charge for data?
The dynamics around data fees has certainly been an evolving trend in the equity markets. And one of those things I think it's really important to recognize. First, all of our fees are filed with the SEC. Second, competition has led to a dramatic reduction in transaction fees, but an increase in fixed costs like market data on brokers and those that are connecting to the exchange. The all-in cost to trade is less than it used to be. But what we're seeing is the retail investor is undeniably the beneficiary of that trend.
How, though, do you see that playing out with the DOJ? Because on the one hand, you have a lot more exchanges coming to market, so you have a lot more competition, in part because of the data fees. And then the DOJ is successful with moving forward some of this antitrust. You're going to get pushback on a regulatory stance. How do you deal with both?
This is a very competitive landscape. In fact, at the New York Stock Exchange, we operate 5 different equity markets. Our customers do not take all of our data feeds for all of the markets. They take the ones that fit for them. So that's a choice. That's a competitive marketplace. So that's why, we've seen how that evolves. And so new exchanges will have that same hurdle as to whether or not they're providing value to their customers that they want to be able to go out and subscribe to their feeds. It's a very competitive marketplace, much like the evolution of content generally. As I look at my trends and my buying trends across Netflix or Hulu or Disney Plus or HBO, we're all making different decisions than we made 10 or 15 years ago about what we value.
Interesting comparison. Do you expect the cost of data to come down?
I expect it to be driven by our competitive forces as it has been to date. And I reemphasize, not everybody buys every product. They buy what they value.
Are you concerned about more exchanges coming to market?
We've been in this business for a long time, and certainly we've seen this movie before, where exchanges, especially brokers, might come together and launch a new exchange. It's not something that's unusual for us, and we're happy to compete in that space.
Stacey, it was really fun to talk to you. We really enjoyed it. We both had a really good time with the conversation. Stacey Cunningham, NYSE president. We should also note Bloomberg LP, the parent company of Bloomberg News, is among firms that have contested exchange fees increases for proprietary data feeds.